Think about the last time you bought something online and split the cost into monthly installments directly at the checkout, or managed your assets through a retail app on your phone. In these moments, you are securing credit and managing wealth without ever speaking to a loan officer or stepping foot inside a bank. This frictionless digital interaction feels worlds away from the traditional legacy experience, the physical branch, the waiting lines, and the centralized bureaucracy required to verify a single document signature. This transition represents a significant change in how we establish financial trust. We are moving away from centralized institutions as the primary gatekeepers of our transactions, relying instead upon integrated digital infrastructure. To understand why these long-standing institutions now face the risk of obsolescence, we have to look at the original survival problem a bank was actually built to solve. 4,000 years ago, in ancient Mesopotamia, storing or moving wealth was a deadly logistical risk. If you were a merchant carrying textiles or silver through territory controlled by warlords, you were a target. The ultimate solution came from the priests. Because religious temples were the most heavily guarded and well-built structures in the city, they were the only institutions immune to casual theft. This cuneiform clay tablet recorded the first credit system. Merchants deposited grain or gold for safekeeping, and priests used a grid like this to record the transaction. These specific segmented markings allowed the tablets to function as receipts. Because the temple was trusted, merchants traded the clay tablets themselves instead of moving heavy physical goods. This was the birth of abstract transferable wealth. This first era of banking relied entirely on a foundation of divine authority and the physical security of temple walls. By the Renaissance, financial power shifted. In Italian trade hubs like Florence, wealthy merchant families moved the center of finance away from the temples and into commercial trade networks. In Europe, goldsmiths became the new intermediaries. They stored heavy gold coins in their vaults and issued paper receipts to depositors for use in daily trade. The goldsmiths eventually made a crucial observation. Depositors rarely showed up to claim their physical gold all at the same time. Most of the wealth sat idle in the vault. This is fractional reserve banking. Goldsmiths lent extra receipts for gold they didn't hold. For every vault coin, they issued 9 notes. As loans were redeposited, the money supply ballooned, cascading outward far beyond the physical metal. Trust shifted from the physical asset to the intermediary. Success now depended on the reputation of the goldsmith, specifically the belief that they held enough reserves to handle a normal day of withdrawals. This system had a fatal flaw. If a rumor spread that a bank lacked sufficient reserves, every depositor would rush to claim their gold simultaneously. These bank runs could trigger a total collapse of the local economy. These recurring crises forced governments to take a more active role. Starting in the 17th century, states began establishing central banks to regulate the industry. Institutions like the Bank of England centralized gold storage and acted as a lender of last resort. By guaranteeing emergency funds to commercial banks during a crisis, they effectively institutionalized public trust. The burden of trust had completed its second great shift, moving from the reputations of individual merchants to the regulatory power and legal authority of the state. Today, that state-regulated framework is being tested. New digital networks are circumventing traditional human intermediaries to create a direct, decentralized financial ecosystem. This is decentralized finance, or DeFi. Built on blockchain technology, it allows users to lend, borrow, and trade assets without the need for a central bank or a corporate headquarters. This diagram shows a DeFi protocol replacing the bank with code. Smart contracts move funds between investors and users based on algorithmic rules. This algorithmic transparency removes friction, but introduces risks. If the code fails, there is no government backstop to recover lost funds. Parallel to this, embedded finance is moving these same seamless capabilities into non-financial apps. By making banking a background feature of retail and social platforms, the traditional branch is becoming invisible. The future of finance appears to be a hybrid of these models, but the core lesson of 5 millennia stands. Whether the ledger is carved in clay, locked in a vault, or written in code, whoever controls the architecture of trust controls the future of the economy.